Okay, so in this video, I'm going to talk a little bit about a few uses of annuity contracts. One use would be within a retirement plan or an IRA. So if an annuity is within a traditional 401k kind of a plan, so a retirement plan or an IRA, those are typically going to be qualified annuities. They're qualified basically because the annuity is being purchased with pre-tax dollars. And if it's being purchased with pre-tax dollars, what that's going to mean is there's no basis in the annuity, and as a result, when the withdrawals are ultimately eventually made from the annuity and ultimately out of the IRA or retirement plan, then basically those are going to be taxable withdrawals. Another possible use of annuity contracts would be to fund damages awarded in lawsuits. So if a lawsuit awarded a certain amount of damages, then basically what could happen at that point is an annuity could be used to provide a stream of cash to whoever had been awarded the damages. So instead of a lump sum, they could receive a stream of cash over a period of time, and that could make sense depending on the type of the damages. You know, if it was some kind of a damage that resulted in a disability, for instance, affecting the person's ability to earn income over their life, maybe it makes sense to kind of structure the damages awarded in the form of more of an income over the person's life. So, you know, that could be a use of an annuity contract. Lottery winners oftentimes have a choice between, if it's a large payout, a choice between a lump sum or an amount that they get every year over a specified number of years. So you could actually do a little time value of money calculation on that to kind of figure out what the sort of implied discount rate is. Because in effect, what you're doing in that case is you sort of give up the lump sum in exchange for buying essentially a stream of annuity payments. So that would be kind of an interesting little time value money exercise to kind of figure out, you know, what is the sort of embedded rate of return in that choice. Retirement planning is kind of already mentioned that a little bit through the retirement accounts, but just from a planning perspective, you could evaluate the income you're expecting to receive from Social Security. You could evaluate your retirement accounts, and possibly decide to convert a portion. Probably wouldn't want to convert all, but you might be able to convert a portion of retirement assets to an annuity to provide basically more consistent income. And so you'd have maybe Social Security plus some income from an annuity plus some other investments that are providing returns that are more subject to variability, things like that. So it can be a component of a comprehensive retirement plan as well, perhaps. Obviously, based on the discussions in prior videos, it'd be necessary to ensure that the fee structure was appropriate and the cost made sense, and that it was a good choice for a particular situation. But that's a possibility. Another possible use of annuity contracts would be sort of longevity insurance, and this actually came up in the long-term care insurance discussion. The idea there is it's annuity, but the payments don't start until a later date. And so this would sort of be a little bit of a backstop if you're concerned that you might outlive your money, that kind of thing, a retirement. Then by purchasing an annuity that starts making payments at a later date, would basically provide a little bit of insurance that you wouldn't kind of outlive your money. It really, if you think about Social Security typically makes consistent payments over time. So really, Social Security kind of has significant characteristics of an annuity in that you kind of pay into it for a period of time, and then when you start receiving a benefit amount, you're getting a consistent payment per period. Importantly, there's a little sidebar here. The amount that you get out is linked, but not as directly linked as you might think to what you paid in. So they are directly linked, but it's not like the money you paid in goes into a separate, distinct account that is owned only by you. The money that you pay in is essentially pooled, and then they track what your earnings are, and they essentially calculate the level of benefit that you receive later. But those benefit payments are kind of like an annuity in many respects. Structured settlements are kind of interesting. So if there is some kind of a legal settlement that was assessed against somebody, then in that case, what they can do is if the person who was injured in some capacity or harmed in some capacity was awarded basically a payout or a settlement, sometimes those are designed in an annuity kind of framework. And so it's a structured settlement where a settlement's been awarded, but they're going to receive essentially payouts over time. So maybe over the next 10 years or until they die, whichever comes first, or something like that. So in some cases, people who have received a structured settlement, what they do is in some cases they actually sell that to essentially cash out. And so there's a secondary market for these structured settlements where basically people who have received the structured settlement sell it to another entity. When they sell that to the other entity, then like a factoring company, that factoring company can then in turn sell it on to investors and things like that. In some cases, there are some questions that need to be asked for those. Is this even legal? For some types of structured settlements, it may not be legal for them to be sold to other entities. There also could be some concerns there that when it's sold to a factoring company, the factoring company sells something to another investor, then the issue you might have there is, well, what happens if the original person who is receiving the structured settlement that's underlying all this, but what if they die early? Presumably the payments stop occurring, and so if the payments stop occurring, is there a life insurance component on that original person to ensure that there's money so the person who did this secondary market transaction for the structured settlement actually still gets paid for the duration of the payments that they were promised, right? So you can have all kinds of interesting quirks associated with this, and there can be various rules and regulations about whether or not these things can even be sold, whether or not you can buy them, under what conditions. It might depend on the type of settlement and so forth. So there is a secondary market where people actually sell these structured settlements, which are basically annuities, and then somebody else can basically buy them. But there are all kinds of interesting rules and regulations for that. So it's sort of a buyer beware scenario to make sure that you're very aware of the limitations associated with that. And of course, the company the factoring company that's in the middle that's kind of facilitating this transaction, well, they're going to charge fees and they're going to take a cut too. So it may wind up being an expensive option in some cases, but it is an interesting section of the financial markets that exists. Also, and I kind of mentioned this indirectly, but previously annuities could be used for damages. So, if a damage judgment was rendered that somebody's going to have to pay damages, then annuities can be used to pay that. Now, you can have kind of two different types of or classifications of damages. And basically, what you can have for damages, you can have essentially the kind of the punitive damages, or also the damages that are just designed to make whole the original individual who was damaged. So you can have kind of the damage, the punitive piece is generally going to be a situation that's going to be more of a taxable kind of a situation. The piece that is sort of trying to make the person whole who was damaged generally wouldn't be, because the whole point was to make them whole. So that's something to kind of be aware of if there are annuities that are constructed from a damage assessment or damage that was awarded. The sort of the source of the damage and the source of the kind of the assessment. I don't know if the assessment is the right term, but the what was awarded through the courts could actually affect the taxation of it. So this is something to kind of be aware of, but they are often used for those kinds of situations. Okay, hopefully this video has been helpful, and thank you for watching, and have a great day.